video this morning to dive into the platform and at the same time try for me to answer so many of the questions that I receive now on Substack or Discord. Please keep them coming. Hopefully you can get a feel of how I'm using the tool to spend less time looking for setups, focusing on stuff that really matters. So as usual, I start with the VRP page. You can see trades that are going to be recommended either at 9 DTs or 30 DTs. You can switch between stocks and ETF. I like to trade ETF. If that's really go-to. The main reason is you never know what can happen with a stock. Is that Tylenol? That's the name of the medicines that Trump has mentioned the other day, and now that means a company is waking up with, I don't know, -10, -50%. You don't have that level of risk at an ETF level. Usually I tend to focus on those. It doesn't mean that it's perfect, but overall I see better result. And now between 9 days and 30 days, I do prefer 30 days, at least at the moment. That's really dependent on the regime you are. It doesn't mean you shouldn't consider 90s. In fact, right now there's a few opportunities that looks quite nice. Particular Boyle has been annihilated the last few weeks and months. Yeah, I think it's trading somewhere at like 25 at the moment. And basically what we're saying here is VRP is quite stretched, right? And the implied volatility you sell right now, 9 days, has 85% chance to be above the subsequent realized volatility. Right? I'm computing many features regarding option market for Boyle, VRP obviously. I'm computing realized volatility obviously around the skew. I'm using all of these features into a machine learning model, and then I'm ending up with very handy probabilities. You also have probabilities right there, right? This really should help you to get a sense of what kind of movement we expect in the product. If you consider Boyle right now, especially at 9 days, you need to be aware of this. Right now we're saying the realized volatility is likely to increase for the next week. So ultimately, when you are going to be structuring a trade, you want to keep that in mind because, well, Boyle has a tendency to move quite a lot. So you have to think about potential hedges, right? We'll come to that in a second. Then for the rest, we're basically saying that there's some good chance for implied volatility to go down. Right now, it's currently at 96. It's quite high. Also, the VRP is really stretched, right? 45 points of vol, that's not nothing. Indeed, it starts to be a good trade to consider short term. But yeah, there's a few stuff you want to be aware of, and this one is one of them. At the moment, the slope is severely in backwardation. We're basically saying it's probably going to relax a little bit over the next week. So we want to understand more about why we think the VRP in Boyle is juicy, and we can open the page where there is more details about that analysis, and we're going to find some explanation as to what are the key drivers that are justifying our prediction. Right? In that case, we're saying that the VRP at 9 days is extremely stretched. Score 4, that's actually quite rare. Therefore, that is a very strong justification to sell it, or at least expect that anything you sell implied volatility wise is going to be above the subsequent realized volatility. And indeed, the second factor that is quite important at the moment is implied volatility measure at 9 day. So as we said before, right, we saw that on the previous page, it's currently at 96.6. It's high, but apparently it's been even higher. When we look at the P term structure, you have a bit of premium all along the way. It's not that surprising. And ultimately, when you see something like that, obviously you will want to come and harvest it around here. I'm in the camp that you don't need to take unnecessary gamma risk if you have a decent bit of VRP right there. So what we really want to do right now in the analysis is, okay, well, there's clearly a strong signal at 9 days, what about 30 days? And now the signal is less clear. Right? This is why it's interesting for me to always put these charts and assets you will find ultimately in the dashboard. But you just use the dashboard, ultimately you're going to see this and you're like, oh great, well VRP at 28 days is 2. That's some decent VRP right there. I can just go sell there. It's probably not a bad trade, but as it is right now, the hedge is a little pronounced and a little on your side. You compare IV, it's 84, it's still pretty high, but yeah, VRP is a little compressed. I think we have 45 at 9 days. We have 26 here. And also what's slightly more concerning is in that realized volatility is still projected to increase for the next 2 weeks. So again, if you have to pick one, you probably want to pick that one. Then comes the question of how do you structure that one? Right, so let's have a look at the main dashboard, Boyle, and try to insights and ultimately decide how we could be trading it. So there's a video on the volatility cone. If you guys want to watch it, that's a great asset. But when you look at this, the VRP is obvious, right? And basically trade where those leads are, and at the moment the volatility is around here. That is indicative for Boyle at the moment. You're basically selling something that is the most realized volatility we've observed for the last year or so. So it's worth considering. Now, obviously, realized volatility and implied volatility in particular are there for a reason. Getting into the winter period, so I guess that's what's justified right now, the prices for implied volatility, and people are a little concerned about what could happen to the product. That might be the reason why you have those prices. But in any case, when you look at this, you can clearly see the VRP. You can also clearly see the VRP right here. That's the chart we were seeing in a second, and that it's back in full force right from last week. Last time we had 14 DTE contracts, so that was the 12. On the 19th, we had another one. We had something like 27.6 in the product. That's not nothing. We're basically back to where we were somewhere in April, May, post-tariff war. So once again, you want to have a feeling for what's happening right now in the product and maybe decide whether or not you want to take that trade. But again, probabilities are on your side. Question really was, how do we structure that, considering that we're not too keen on being around here? So that means you will have to sell more around there. Usually at that stage, you want to make sure that, first of all, the term structure has a normal shape. That's not the case at all right now. Like you have that weird curve where it's quite big in the very short term and then relax and then go up again. It's typical from term structures that are under heavy stress. Look actually at the vol of vol. So it's the volatility of implied volatility, right? It's quite high and quite stretched. So it's not surprising to see stuff like this. But at the same time, this should also get us to be again on the more cautious side. So you could consider obviously to go with a very large strong goal. You would probably be fine. But considering how things move and considering that market is quite angsty about how things are happening right now, I would say that a bet on the shape of the term structure is proper at that stage. So you would want to sell 9 days and then 30 days. So a calendar spread right now seems adequate for trading there. Now, if you feel comfortable with what you see, right, things wrong with selling those. Let's now have a look at the vol surface and see how implied volatility is spread out. Unsurprisingly, you have a little while more than you have smirk. Right? You see quite the beat at the tail on the call side and then the put side. It's not that stretched though. We've seen it higher than that. The first time I'm looking into Boyle in almost 3 months. The last time I traded it was somewhere in May actually. Belly of the curve is not that stretched when you compare implied volatility to itself. But then when you look at the skew, you start to see some interesting patterns, right? Apparently, the skew on the put side is very pronounced at around 2-3 months. Here, it's even more pronounced around there at 6 months. Usually people don't trade there, but sometimes there's nothing wrong with considering those longer expiries. For the way we trade though, we really want to see is the VRP, and it's pretty apparent what's happening right now. The entire vol surface has been lifted. People are angsty as we get into the winter season. Here in case you also have some VRP. That's what we saw earlier on in some of the insights. But remember, this is not necessarily a place where we really want to be active. So the way I'm looking at this is indeed it's quite equally distributed across calls and puts. You have some skew, but there isn't something really smart to be playing here. It really becomes a bit of a term structure play where I want to you want to bet that term structure is gonna go back to a more contango kind of shape. Ultimately, what you're trying to do is harvest this part and then hedge yourself with this, right? If really something terrible was happening in the front, it's likely that volatility right there would also up at some point. So some sort of calendars where you sell somewhere between 10 and 14 days and then hedge with this is probably good enough for Boyle. Now, once again, everybody has the same tolerance and risk limits. If you want to go with a 20 delta strangle, for instance, I mean, the justifications are there, right? You have the probability on your side. Just bear in mind your risk. Make sure that you can handle oil shooting up, I don't know, 20, 30% in a couple of days because of the forecast that has an impact on it. I don't know what else could impact it, but just make sure that you can handle this kind of movement. That's it for Boyle. Hope you guys enjoyed the video. If you have any questions, comments, as usual, don't hesitate to ping me and I'll do my best to answer. See you.